Welcome, for every successful Canadian business owner, there's this inevitable moment of realization. The corporate structure that was perfect for starting up and growing your business, well, it might not be the right one to carry you into the future. The conversation has to shift, right? It goes from day-to-day operations to thinking about long-term wealth, about tax efficiency, and of course, about your legacy. And that's exactly what we're going to tackle today. We're staging a a Canadian tax showdown. We're putting two of the most powerful tools in a business owner's toolkit head to head, the holding corporation and the family trust. My objective here is simple. We're going to break down how each one works, we'll line them up and compare their strengths and weaknesses, and by the end, you should have a solid framework to help you decide which path might be the right one for you. So here's our game plan. We'll start by talking about what you're actually trying to accomplish, the crossroads you're at. Then we'll get into the nuts and bolts of each structure. From there, it's the head-to-head comparison. And finally, we'll pull it all together to help you think about choosing your own path. All right, first things first. Before we can even start talking about which tool is better, we have to define what better even means. We need a yardstick to measure them against. So what are we really trying to achieve with a corporate reorganization? For most business owners who've reached a certain level of success, the goals tend to become very clear, circling around a few key financial and personal objectives. So let's lay out these 6 critical goals. Think of this as our scorecard for the rest of our discussion. First, and this is a big one, how do we use the lifetime capital gains exemption, or LCGE, to save a massive amount of tax when we sell? Second, can we take that amazing benefit and multiply it across our family? Third, what's the most tax-efficient way to pass the business down to our children? Fourth, how do we protect our investment portfolio from any liabilities or lawsuits that could hit the main business? And finally, we have to be practical. We'll look at setup costs and complexity, and we'll consider how long these structures can actually last. Okay, our scorecard is set. Now it's time to get into the mechanics of these two options. What are they really? And just as important, how do you even set them up? Let's begin with the one you've probably heard more about, the holding corporation. Now, this is a really important point to grasp right away. A holding corporation, or a holdco as we often call it, isn't some magical special legal entity. It's just a regular, everyday Canadian corporation. The only thing that makes it special is its job. Its primary purpose isn't to sell widgets or provide services. Its job is to own the shares of the company that does do all that. It separates your operations from your investments. So you might be wondering, okay, but how do I get my existing valuable company inside this new holdco without triggering a huge tax bill on the sale? And that is the million-dollar question. The answer lies in a really elegant piece of our tax code called a Section 85 rollover. Let me walk you through it. Step 1, you create a brand new corporation, the holdco. Step 2, you sell your shares of your operating business to this new holdco. But, and this is the magic part, you and the holdco file a special form, an election, that tells the government you agree to do this transaction at your original cost, not its current high value. So no capital gain, no media tax. In exchange for those shares, the holdco issues you new preferred shares that lock in the value you've already built. It's a brilliant way to restructure tax-free. Okay, now let's switch gears completely and talk about the family trust. This is fundamentally different. A trust isn't a company. You can't hold it in your hand. It's actually a legal arrangement, a relationship between 3 parties. Think of it like this. You have the settlor, who creates the trust, kind of like the person who writes the rule book. Then you have the trustees, that's usually you and maybe your spouse, who are the managers, making all the decisions. And finally, you have the beneficiaries, typically your children or other family members, who are the ones that ultimately get to enjoy the income and assets held by the trust. So how does a trust actually get a piece of your business? Well, it's through a maneuver called an estate freeze. The name really says it all. The goal is to freeze the value of the business in your hands today so that all the future growth can go to your family tax efficiently. Here's the play-by-play. First, you do a share exchange. You trade in your common shares, the ones that grow in value, for new preferred shares that have a fixed value, like a price tag stamped right on them equal to what the business is worth today. That's the freeze. Step 2, the new family trust comes in and buys a brand new set of common shares for just a few dollars. And here's the punchline. From that moment on, all the future growth, every bit of new value belongs to those new shares held by the trust for your beneficiaries. All right, now that we've got a handle on the mechanics of a holdco and a family trust, it's time for the main event. Let's put them in the ring and see how they perform when we measure them against those 6 key goals we set up earlier. And we're going to start with perhaps the most important goal for many owners, claiming the lifetime capital gains exemption, the LCGE. Honestly, this is one of the single greatest tax planning opportunities available in Canada. So the question is, does your choice of structure make it easier or harder to get? And let's be clear about just how valuable this is. We're talking about the ability for one person to earn over $1 million in capital gains completely tax-free on the sale of their business shares. To put that in perspective, depending on your province, that's a direct tax saving of somewhere around $300,000, maybe more. This isn't small change. It is absolutely a goal you want to build your entire structure around. So why does this structure matter so much? Well, to qualify for the LCGA, your company has to be what we call clean. It has to pass certain tests showing that almost all of its assets are used in an active business, not just sitting there as passive investments. Now, with a holdco, you run into a problem. You pull profits up from your operating company to invest them, but those investments are still part of the overall corporate group. They can contaminate the mix and cause you to fail the asset tests. But the family trust, it's much more elegant. It can take dividends from the clean operating company and stream them out to a totally separate corporation for your investments. The operating company stays pure, making it way easier to qualify for the LCGA. For this goal, it's not even close. The family trust is the clear winner. Okay, so the family trust is better for you to claim your exemption. But what if we could do even better? What if we could multiply this incredible tax break across your entire family? And this is where the family trust goes from being a great idea to an absolute game changer. See, with a holdco, you're pretty much stuck. You own the shares, you get the exemption. Adding your kids as shareholders later on is messy and can trigger tax. But a trust is designed for this. When the business is sold, the trustees can literally sprinkle the capital gain among the various beneficiaries. That means your spouse can use their exemption, your children can each use their exemptions. It's an incredibly powerful tool for multiplying wealth. Again, the family trust wins this round hands down. Let's just run the numbers on that for a second, because they are staggering. Imagine a family of 4, you, your spouse, and 2 kids. Each has their own $1 million plus exemption. We're now talking about sheltering something in the neighborhood of $5 million of capital gain from tax. The tax savings on that could easily be over $1.5 million. That is life-changing money, and it's all thanks to the right structure. Now let's talk about passing the torch, succession planning. With a holdco structure, it can be a bit rigid. To get shares to your kids, they either have to buy them from you, which triggers tax, or you can do a freeze where they only get the future growth. But a family trust, it's incredibly flexible. It can simply distribute the company shares it owns directly to the children, and it can do so tax-free. Better yet, you don't have to decide everything today. You can wait and see which child is really passionate about the business before you decide how to allocate the shares. For succession, that flexibility is priceless. All right. What about asset protection, shielding your nest egg from the risks of the active business? Well, I have good news here. Both structures are excellent at this. A holdco, by definition, is a separate legal box. So if the operating company faces a lawsuit, the assets in the holdco are safe. A family trust gets you to the very same place, just in a slightly different way, by flowing funds to a separate wealth corporation that it owns. So on this point, we're calling it a draw. Both get an A+. So far, the trust is looking pretty good. But let's get back down to earth and talk about practicalities, like cost and complexity. And this is where the holding corporation scores a major point. Setting up a holdco is a fairly routine procedure for most corporate lawyers and accountants. A family trust, on the other hand, is a more complex beast. It costs more to set up, and it often requires an expensive business valuation. Plus, the annual accounting and tax filings for a trust are specialized work. This means higher ongoing professional fees. So, for cost and simplicity, the holdco is the clear winner. Okay, our last point on the scorecard, longevity. How long can these structures last? A corporation is simple. It can exist forever, in perpetuity. It's a very stable, long-term vehicle. A family trust, however, has a built-in expiry date. It's subject to something called the 21-year rule. In short, the taxman says that every 21 years, the trust has to pretend it sold everything at its current value. This creates a massive tax bill on unrealized gains. So in practice, you almost always have to wind up the trust and distribute the assets before you hit that 21-year mark. When it comes to building a structure for generations, the corporation's perpetual nature gives it the edge. So we've broken down the structures. We've gone through the head-to-head comparison. Now it's time to bring it all home. What does this actually mean for you when you're standing at this crossroads? Let's wrap this up with a final summary. And here it is, the final scorecard. It really paints a clear picture, doesn't it? If your world revolves around maximizing that lifetime capital gains exemption, especially across your family, and you want maximum flexibility for passing the business to your kids, the family trust is, without a doubt, the superior tool. But if your priorities are more about keeping costs down, keeping things simple, and building a structure that can stand the test of time for many generations, then the holding corporation is probably the stronger contender. And remember, on asset protection, they both deliver. And that brings us to the most important conclusion of all. There is no single right answer here. One is not inherently better than the other. The best choice depends entirely on your goals. You have to ask yourself, is my main objective a tax-efficient sale in the near future? Or am I trying to build an empire that will pass to my grandchildren? The answer to that question will point you to the right structure. In the end, your corporate structure is more than just a legal document. It's the blueprint for the future of your business, your wealth, and your family. It's a story you are writing for the next generation. So, the question I'll leave you with is this: what story do you want your structure to tell? Take these ideas, think about your own priorities, and have a detailed conversation with your tax and legal advisors. They can help you build the right foundation for that future you envision. Thank you.